Hello everyone, welcome to QuintEdge. This is CA FRM Yes Jan, and in this video we are going to start with a series called as Investment Banking Interview Questions. I'll be uploading video after video in which I'll be trying to cover every technical questions that could be asked in a typical investment banking interview. So if you're preparing for investment banking jobs, my recommendation is watch this video with a paper and pen. Note down the answers for the questions and be prepared for interviews. Let us get started. Okay, so first thing first, what are the types of questions that could be asked in a typical investment banking interview? 5 types of questions could be asked. One of them will be related to valuation. Or they could be related to accounting. Or they could be related to financial modeling. Or they could be related to current economic environment. What is happening in the economy? How do you anticipate interest rates to behave, inflation to behave, oil prices to behave? What's the current oil price per barrel? All these questions, like what is happening globally and domestically. And then some riddles, some brain teaser questions. In this particular video, I'm going to focus on this valuation related question. Okay, and that too within valuation, there are multiple methods. I cannot cover entire questions in one particular video. It will be 10-15 hours of video. So what I'm going to do this in this is there is one method within types of valuations method called as intrinsic valuation, and within intrinsic valuation there is a method called as discounted cash flow. I'm just going to talk about discounted cash flow over here. Okay, in fact this is first investment banking interview question. What are the 3 major valuation methodologies? So everyone listen. Valuation methodology can be divided into 2 broad parts: intrinsic valuation and relative valuation. Are there any other valuation methodologies other than these two? Yes, there are. There is liquidating assets valuation when the company's going concern is not sure, or there is option valuation using Black-Scholes or binomial. So many other methods are there. But in investment banking, primarily these two are used. Intrinsic, from inside, inner. So intrinsic valuation is based on cash flows, growth of those cash flows, and risk of the company, cost of capital. This is the internal factors to the company. Relative valuation is valuation by comparison. You try to compare your company or target company with other companies and you try to come up with the valuation. Okay. Now within intrinsic valuation, there are 2 sub methods. One is called as DDM, dividend discount model, and another one is called as DCF, discounted cash flow approach. Within relative valuation, there are 2 broad approaches again. One is called as comparable company analysis or public company analysis, and next one is called as precedent transaction analysis or past transaction analysis. Now, the entire modern finance is based on the theory that value of an asset is equals to the present value of its future expected cash flow. Whatever cash flow it is going to generate in future, if we calculate present value of those cash flows, that becomes the fair value of the asset. Intrinsic value is based on that. Relative valuation is based on valuation by comparison. So since we are not going to focus too much on this part right now, I'll give you an example and then we'll move to this. Okay. So let's say if I want to buy a flat in Delhi NCR region, maybe in central Delhi, because our office is in central Delhi. So I want it should be near Patel Nagar, and I want that it should be in a gated society, hospital, market should be nearby, metro station should be nearby. I'm shifting for the first time in this region and I want approximately 1,000 square feet of flat. So approximately 2.5 BHK. Now I'll go to the broker. What he is going to do, he is going to compare, okay, in this particular type of locality in central Delhi, Kirti Nagar, Patel Nagar type of area, the flat size approximately is 1000 square feet, and those flats have maybe rental yield of or selling price of 1.5 crores to 2 crores. So you can calculate rate per square feet. Rate per square feet, let's say, is 15,000 rupees per square feet. Now 15,000 rupees per square feet into 1000 square feet, that is going to give me valuation of my flat. So that 15,000 rupees per square feet, the multiple, the price multiple, comes by comparing it with similar flats that are based in central Delhi, near the near Patel Nagar, they're close to metro station, in a gated society, 1000 square feet of size, with all the amenities in the society, are costing 15,000 rupees on an average per square feet. I should also get it around this region. So maybe between 1.3 to 1.7 lakhs, like something like this. This is relative valuation, valuation by comparison. This is intrinsic valuation now. Intrinsic valuation, the theory is anything that has came to life will die. This is a typical corporate business cycle, right? It grows very fast, growth flattens out and declines. But when we are doing valuation, we assume the graph is going to be like this. This part we don't assume. So, and there is a reason behind it, I'll tell you maybe in some time. But we assume that whatever cash flows we are going to generate, they will be generated at a constant rate when the company matures. So we make projections for this period. After making projections for this period, this is infinite in nature, foreseeable future. So you cannot make infinite projections. So we calculate something called as terminal value. And then we calculate present value of terminal value and present value of all the cash flows that we are generating during this explicit period. This is how it works. Now the cash flows enjoyed by the owners of the company. One is dividend. Ultimately, if you buy the company, maybe you buy it over here, you hold it for very long. The company will grow. The company will decline. In the end, capital gain will be zero. But whatever the company have earned, you will end up receiving in the form of dividends, right? So this is dividend discount model. Theoretically sound, practically we don't use it, but because there is a flaw in this method. Only dividend is not the cash flow of the shareholders. The real generation, like maybe the company earns profit, it doesn't distribute. Then also the profit belongs to the shareholders, right? The cash flow belongs to the shareholders. So discounted cash flow is a broader approach that says any free cash flow generated by the company. What is a free cash flow? We'll discuss in some time. Any free cash flow generated by the company belongs to the shareholders and they ultimately have the right to claim it from the company. So we calculate free cash flows, we discount them, we forecast them, then we discount them. Whatever is the present value of this, it becomes the value of the company. So this is the broader understanding of all valuation methodology, and in the whole process I have given you answer for this. Now walk me through a DCF. So the interviewer is expecting you to give certain steps. First is forecast free cash flows. Forecast free cash flow. So forecast profits, changes in working capital, capex, non cash expenses, all these things you need to forecast. Then calculate free cash flows. How to calculate it, we'll discuss it in some time. After forecasting free cash flows, calculate sustainable growth rate, and using this calculate terminal value. So a company can keep on expanding itself by internally generated profits, internally generated cash flows, right? So it will generate cash flows, will invest it. So the capital base will become bigger. More cash flows will be generated, will invest it. More cash flow will be generated, will invest it. That is, it doesn't need any external funding. So till the time it becomes mature, it needs external funding. After becoming mature, it doesn't need external funding. Before also, it necessarily need not it, But after becoming a mature company, until unless it is willing to do huge capex, that doesn't, like the mature company definition is, it's going to invest majorly in the maintenance of capex. Whatever capex it should have done, it have already done it. Then you calculate sustainable growth rate, and after sustainable growth rate you calculate terminal value, that is value of all these cash flows at the end of forecast period. Then you discount free cash flows and terminal value. So to discount free cash flows and terminal value, you need cost of capital. So if you do this, you will be able to arrive at value of firm. From this value of firm, subtract debt, add cash, add investments, you will be arriving at value of equity. This is the entire process. Okay. All these things can be discussed for multiple hours. Like how do we forecast free cash flows? We can have a very long discussion on this, but a 2-minute answer will be this. Then what is free cash flows and how do you calculate it in DCF? Free cash flow, firstly meaning, free cash flow is the cash flow available to the company or available to equity shareholders, both are different, after doing the necessary expenditure, after investing in the company for its growth and its maintenance. Whatever is left is free cash flow to firm. After paying off the debt and its interest, whatever is left for the ultimate owners of the company is free cash flow to equity. So free cash flow can be divided into two parts: free cash flow to firm and free cash flow to equity. Let's discuss firstly free cash flow to firm. You calculate profit of the firm before tax, operating profit. At firm level, for all the providers of capital, what's the operating profit? So EBIT, this is for debt plus equity. From this, you subtract the taxes, you arrive at net operating profit after tax. This is profit after tax at firm level. This is also for debt plus equity. Basically, it is for entire firm, all the providers of capital. Now, in this, you make adjustments. Firstly, of changes in working capital. Then, capex. So, this is the investment to maintain the business, to run the business. This is the investment to grow the business. And then to arrive at EBIT, you might have used some non-cash expenses, right? Working capital already is taking care of some non-cash expenses. Other than this, also depreciation is there, stock appreciation, stock ESOPs, etc. So given to the employees, those expenses are there. You add them back, non-cash expenses. You arrive at free cash flow to firm. Free cash flow to firm. This is also of debt plus equity. This belongs to the firm. Now, from free cash flow to firm, whatever expenses you should do, you have deducted. Now, from free cash flow to firm, maybe I'll write here, pay interest, but whenever you pay interest, profit goes down, therefore tax goes down. So when you pay interest, there is tax saving. So interest should be post-tax, 1 minus tax rate. Then whatever debt you are going to take or whatever debt you are going to repay, debt payment or debt taken. This will give you free cash flow to equity. Okay, this is free cash flow to equity and this is how you calculate it. There are profits, multiple ways of calculating it. Like one formula could be linked to EBITDA, one formula can be linked to net profit, but ultimately the number is going to be the same. In interviews, if you describe this, it's going to be perfectly fine. And in real also we use this formula more often than not, because for every company operating profit is available. EBITDA is not a is a non-GAAP item. It's not visible in the the P&L balance sheet. Okay, it's not visible in profit and loss account. Now, how do you use free cash flows instead of net income in? Why do you use free cash flow instead of net income in DCF? So I think we are discussing this only. Why do we can arrive at net free cash flow to firm using net income formula, but why we say free cash flows discounted? Why don't we discount net income? Because net income is not equals to cash flow available. Net income is calculated by making adjustments as per accounting, and accounting have something, a rule of accounting in which you tend to recognize revenues even if you have not received the cash for it, and you tend to recognize expenses even if you have not paid them. If it becomes due, you will realize it, you will recognize it in your P&L expenses. And revenue, even if you have delivered the goods, all the major risk and reward is transferred, you will recognize the revenue even if you have not received cash for it, right? So basically this net income is not equals to cash that you have received, and then you provide for depreciation etc also. So it is not the cash that is available to the firm, it is just the profit part, and this profit includes cash item plus non-cash item. But to calculate value of any asset, it is present value of its future expected profits. No, future expected cash flows. So future expected cash flows, and this is not a cash item, this is cash plus non-cash items. Therefore, we cannot use net income in DCF valuation. Then how do you calculate the terminal value in DCF? So one question before this could be, what is terminal value, and then how do you calculate it? So what is terminal value? Terminal value is the present value. Present value at end of forecast period of the cash flows that is going to be generated in future. So understand this, when you calculate terminal value, the formula for it, there are two methods basically. One is exit multiple approach and one is Gordon growth model. Gordon growth model is a formula based approach in which you say value of firm at this period, at the end of forecast period, will be the cash flows that you are going to generate next year, FCF of next year, divided by cost of capital minus growth rate. Basically, this is APGP, arithmetic progression, geometric progression formula. So what is happening is your cash flow will grow at a constant rate, right? At maybe 5%, it will continue to grow forever. So it becomes a APGP series, and we want to calculate value of APGP series, sum of infinity. We have all done these type of questions maybe in 7th, 8th, 9th standard. So it is basically that formula. So whatever cash flows, you will use cash flow of 6th year. If you have done forecast for 5 years, you will use cash flow of 6th year and you will get value at the end of 5th year. Now this terminal value also needs to be discounted over here, right? So terminal value, two methods, Gordon growth model and exit multiple. Gordon growth model is generally used by strategic investors, the people who are going to invest in a company for very long term. But a venture capital, PE fund, etc., they will be using exit multiple approach, because they enter into the company, they will be trying their best to grow the company, to expand the multiples, to expand the profit, reduce the leverage, and then ultimately they will exit the company, right? So entry and exit is already planned for them. For them, they will be using exit multiple approach. What they do is basically, there's a multiple, let's say, called as EV by EBITDA, enterprise value by EBITDA of the company. Now this is coming as, for industry it is, let's say, 7x. 7 times of EBITDA is the value of the company. Now EBITDA of the company in this year is, let's say, coming as 5,000 crores. So 5,000 into 7 will be the enterprise value of the company, that is 35,000 crores. From 35,000 crores, you can reduce the debt, add cash, add investments, you will arrive at equity value. So how do you calculate terminal value? Gordon growth model, this formula. Exit multiple, this formula. Now it could be exit multiple of EV by EBITDA, EV by EE, EV by EBIT, EV by sales, PE ratio, any exit multiple that you want to use, you can use, but industry norm is generally using EV by EBITDA. Okay. Now let's move to the next question. What are the two methods to calculate terminal value? I think we have already covered this question in the previous one. Two methods are GGM and EM. GGM is used by strategic investor and EM is used by financial sponsors. I think I have not written it here. It will be used by financial sponsor. Okay, financial sponsor. Now let's move ahead. How do you calculate VAC? Firstly, what is VAC? Weighted average cost of capital is the full form. It is not the meaning. Meaning means on an average, how much investors expect the returns from the company. On an average, what is the expectations of the investors of the company? How much return they want on an average? Weighted average cost of capital. So there are only and only two sources of capital in the world. You can put your own money, that is called as equity. You can take loan and put it into the business, called as debt. So what about preference shares? Preference share is something in between, but broadly there are two sources. It's your money or someone else's money. If it's your money, equity. If it is someone else's money, debt. If you are taking a loan, cost of debt, the rate of interest that you pay on this loan, that is your cost of debt essentially. Now, it is true that cost of debt will be lower than cost of equity because equity holders have upside as well as downside. Debt holders don't have any downside. They will get their principal and interest. If company don't make any profit or make huge profits, they'll end up getting their money, right? But sir, what if company goes bankrupt? In that case, they have legal protection, right? Equity, even if the company goes bankrupt, equity will not get anything until unless company have some extra money left, right? Some surplus is there. So what we do is we want to calculate a weighted average. So whatever is the expected returns of equity, how to calculate it we'll discuss. But whatever is the expected returns of equity, this multiplied by weight of equity plus whatever is the interest payment that you are doing 5%, 7%, 8%, 10%. But when you make interest payments, you end up pushing your profits down because of which you pay less taxes. So there is savings of tax when you pay interest. So cost of debt after tax 1 minus tax rate into weight of debt. Now these weights ideally should be based on market value. I can expand this formula. This is VAC. And I can say cost of equity into value of equity, market value of equity by market value of equity plus market value of debt plus cost of debt post tax into market value of debt divided by market value of debt plus market value of equity. This is the entire formula. Okay. Now let's move ahead. Why do you use VAC and DCF? Okay. So VAC represents expected returns or risk in investments. Basically, how risky a company is. If VAC is higher, if the banks hesitate to give you money, maybe the financial condition is not that good. In that case, you will not get loan at 7, 8, 9%. You will get it at 12, 13, 14, 15%. If cost of debt goes up, cost of equity will be also on higher side, the VAC will increase. So VAC is representing the risk in the company. A mature company will have risk maybe around 8 to 12%. This is what the market returns are generally, right? 8 to 12%, and maybe a very risky company will have VAC like 12 to 15, 18, 20, 25% as well. So why do you use VAC and DCF? So that VAC can tell you about the risk involved in the company. Now, Weighted average cost of capital, WACC, represent risk. Risk is basically, if we have learned this or we have heard this statement, higher the risk, higher the expected returns. So what we try to do is, if expected returns, that is WACC, is higher, we try to imply backwards and say risk will also be higher. Okay. So this is why we use VAC and DCF. Then how do you determine appropriate discount rate to use in DCF? How do you come up with WACC? How do you come up with the components of WACC? How do you calculate KE and KD? So to calculate WACC, to calculate appropriate discount rate, KE and KD, there are multiple methods. But I'm not discussing methods over here. Methods will be covered in the later slide. Here what I want to tell you is, the WACC should be truly representing the risk of the company. And over the period it is possible, let's say company is a startup, it is growing and will stabilize. Here WACC may be 20%, but here WACC may be only 10%, right? So over the period of time, WACC behaves like this. It will reduce as the company will grow, the WACC will reduce, okay? So how do you determine the appropriate discount rate to use in DCF? Looking at multiple factors, including how de-risking the company, the company is de-risking itself. Current market conditions will also determine WACC. If the entire environment is of low interest rates, you'll get money at lower interest rate. Cost of debt will be lower. Even equity will not have a lot of high expectations, right? So it depends. So many factors are there, but broadly on the risk profile of the company and the market conditions, you can come up with a WACC estimate. Then how do you calculate cost of equity? There are multiple methods. I'll just walk you through all of them. In this, the most important one is CAPM. Most of the questions in interview will revolve around CAPM, capital asset pricing model. So it is a regression equation. Those of you are aware of quants, they're aware of regression. It is a regression equation. Equation of a line is y is equals to a plus bx, right? Or y is equals to mx plus c. Now regression equation is this. CAPM also looks like this. KE is equals to RF plus beta into x. X is equity risk premium. Equity risk premium is expected return of market minus risk-free rate. So beta plus RF is equals to K. This is CAPM. Now what is risk-free rate? What is beta? What is RM? We have to discuss all these things. Firstly, risk-free rate. Risk-free rate is when you are making investment and it satisfies two conditions, it is called as risk-free rate. The first thing is, there should not be any risk of default. What do we mean by risk of default? If you are going to get your money, you will get it on time. You will get your money and you will get it on time. So if in case due date is 6th and you are getting it on 9th, is it a default? Yes. Eventually got your money doesn't mean there was no default. On due date, you receive your money. On time, you receive your money. If that is going to happen, default risk is 0, then it becomes risk free. And there is one more part of risk free rate, that is there is no reinvestment risk. That is, if you want money after 5 years, so your investment horizon should be equals to investment period. What I mean to say is, if let's say I want money for after next 5 years, but if I do 1 year FD, after 1 year FD, after 1 year I have to renew that FD again, right? I don't know what will be the rate of return that I'm going to generate. I have two options. If I do 5-year FD today, I'll get, let's say, 7% per annum. So 7%, 7%, 7%, 7%, 7%. I know my money will be invested at 7%, right? So there is no risk. Risk in finance is volatility. It can go up, it can go down. That is the risk. There is, like many people assume the risk is only on downside. In finance, upside is also considered as risk. The volatility part, this uncertainty whether it will go up or down is risk. Now, if I want money after 5 years, but if I make a 1 year FD, after 1 year, I don't know what will be the rate, right? Will I be able to invest my money at 7% or 5% or 12% or 3%? I don't know. That is risk. So risk-free rate have two elements. No default risk and no reinvestment risk. Okay. This is risk-free rate. Beta, we'll discuss. There are questions on beta in some time. Expected return from market. How much you are expecting market to generate over next 1 year. This is a dynamic figure, but many analysts use a historical estimate for this. On an average, stock markets have generated 12% over the period. So I also expected return from the market is 12%. This is fine, but not the best approach. Ideally, it should be telling you, you should not look back and try to forecast. You cannot drive looking into the rear view mirror. You have to see through the windshield. There are approaches for it also, but I don't think it will be asked in an interview that how do you calculate expected market return. There are approaches for it, but like goes beyond this particular video. Maybe when we'll have advanced DCF questions, we'll discuss it. Then dividend discount model. So we know value is equals to free cash flow of next year divided by cost of equity minus growth. This is free cash flow to equity. Okay. Now I want to calculate this. Can I mold this formula? Value is not known, so I can represent it by price. Current price is representing true value of the company. Company is fairly valued in the market. So if I want to calculate KE, this formula can be modified. This KE minus G will go here, P will come over here. So that is KE minus G is equals to FCFE 1 by P. This G will go on that side. So KE is equals to FCFE of next year by price plus growth rate. That is cost of equity. Okay, so this is how you can calculate cost of equity. Then bond yield plus risk premium. If a company have a listed bonds, they are having a yield of, or they are generating, I'm not talking about coupon, I'm talking about yield. On an average, how much they are generating. Those of you understand finance, in reference to BA2 plus calculator, I'm talking about I by Y, interest or yield, right? So that is, let's say 8%. Now we know cost of debt is lower than cost of equity. This is cost of debt. Investors want 8% return from your bond. So cost of equity will be plus something on top of it, right? So bond yield plus risk premium. Generally, this number is decided by a practitioner based on their experience. So it could be any number between 2% to 7-8%. So all the way from 9-10% cost of equity will be to 15-20%. Okay. Build up method, you say cost of debt is risk free rate plus something on top of it. Without taking any risk, you would have generated 6%. If someone is investing in your bond, they are asking for 8%. So this is risk premium. So cost of equity will also be generated like this. You can say risk free rate plus some other premium. It is like industry premium, size premium, SRCP, specific company risk premium. So risk free rate plus industry specific premium, like auto industry should be charge higher premium in comparison to FMCG industry because it is discretionary and it is non-discretionary. Then we have size premium. A smaller company is much riskier than larger company. Then SRCP, company specific risk premium. The company have lot of leverage. The company have corporate governance issues. The company have some penalties that is lying around. It can win or lose the case. Basis that we'll add company specific risk premium. This is built up method. In implied cost of equity in DCF model, so what you do is, in DCF model, ultimately you will be arriving at fair value of the company. Represent or like just back calculate it. Replace fair value with the price and back calculate cost of equity. If cost of equity is this much, what should be the price? Let's go back. What I am saying is, here it is, everyone. In this method, we were discounting FCF, to arrive at value of the firm, and then we arrive at value of equity. Value of equity, if I give it to you, can you back calculate this discount rate? Yes, that is another way. Okay. Let's move back. Now, next question. How do you calculate cost of debt? How do you calculate cost of debt? KD. One is yield to maturity approach. So if the company have a bond, whatever is yield to maturity of this bond, preferably this should be a long-term bond. A long-term bond of the company, preferably long-term, and ideally it should be unsecured as well. Whatever is the yield of that particular bond will become cost of debt of the company, number one. Number two, current cost of debt effective interest rate method. Now, this approach says if company want to raise money today, at what rate they will be getting the money. This is ideally if company goes to the bank today, company calls bank and say, sir, I want to raise maybe 200, 300, 500 crore, large sum of money in comparison to the size of the company. If they want to raise large sum of money, at what rate they will be getting this money today? That is current cost of debt. So what we do is, obviously we cannot call and ask, sir, there is a company listed in the market, it want to raise money today, at what rate will you give me? This is not possible. So what you do is you go and check maybe in very recent time, in last 6 months, 1 year, 3 months, assuming the interest rate environment have not changed a lot. If the company have raised lot of money, at what rate it got that money? That will be becoming cost of debt. Okay. Then debt rating approach. Debt rating approach says if the company have a credit rating, let's say rating of the company is A, right? You will find another company that is rated A. This company is rated A. Its bonds are not there, right? So you'll find another company that is rated A. And this company should have a bond. And that bond's yield, assuming the life of bonds are same, like this bond and that the company have, the life is same, or the company have a bond that's not listed, but their life are same. So you can say whatever is yield of this company will become my yield, right? That is my debt rating approach. Now, risk-free rate plus credit spread approach. Risk-free rate, it is how much you are earning without taking any risk, plus difference of yield. So if a corporate bond is there, this company's bond is generating 8%, a government bond is generating 4%. So the difference 4% you will add over here, ultimately you will arrive at 8%. So that is risk-free rate plus credit spread approach. Then we have weighted average interest rate on debt. If anything doesn't work, you are not able to apply all these methods, then in that case you will pick up the debt schedule. You will see whatever is the average debt balance, that will go in denominator, average debt. In numerator, whatever interest is there, you will see interest that is in P&L, and you will add interest that is capitalized. Please don't directly put interest from their P&L, because many times the company is developing an asset. Any expense incurred till the point asset is ready to use, that expense is added to the cost of asset, including interest. So interest gets capitalized as well. Okay. So add these two divided by average debt, that will tell you almost what is cost of debt. Okay. Now, how do you calculate beta in DCF? Very lengthy discussion, but we'll keep it short. What is beta? We discussed this. It is a regression line. Y is equals to A plus BX. Beta is this value. This value, if you remember from your stats classes or maybe wherever like you have studied this is slope. This is intercept, right? So what is beta? Beta is a slope. it tells you how risky the company is in relation to market. It is a relative measure of risk. There is another measure of risk called as standard deviation, that is absolute measure of risk. Beta is a relative measure of risk. So let me help you to understand this. If let's say stock market is moving like this, my company is moving like this, I can say beta is 2 because it is moving twice the market. So if market moves by 1 unit, my company moves by 2 unit. If market moves by 1 unit, my company moves by 2 unit. I can say beta is equals to 2. Okay. Now, like we cannot visually calculate this. So there are multiple formulas to calculate slope. In geometry, we say y2 minus y1 by x2 minus x1. So this is x1 y1 point and this is x2 y2 point, right? So y2 minus y1 divided by x2 minus x1 give you slope. Slope is basically tan theta of this line. Tan theta of this line is slope. Or a statistical formula of slope is covariance of returns of market and returns of security divided by variance of returns of market. This is formula for slope. There is a formula for slope from correlation as well, but this is the formula that is easy to remember, covariance by variance. Please remember this. This is returns of market and returns of market. In variance, we don't have returns of stock returns, right? Variance of stock returns. It is variance of returns of market. Okay. How do you calculate beta and DCF? This is one way. So there are two approaches. I have told you beta. This beta that you are going to calculate, it is called as regression beta. This beta can be further refined. The refined version of it is called as bottom-up beta. The refined version of it is called as bottom-up beta. Okay. So how do you calculate bottom-up beta? We will discuss that. Bottom-up beta, I am just removing everything and I'll discuss it over here only. Okay. Focus over here. What you will do is you will calculate beta regression of all the competitor company, peer company. Okay. This is interview question, very important interview question. We are calculating bottom up beta. You will calculate beta regression of all the competitor company. Let's say if it is MRF, so I will calculate beta of Apollo tires, C8 tires, right? If it is, let's say, TCS, so I will calculate beta of regression, beta of Wipro, Mindtree, etc. Okay. So this is beta regression. You will get beta value, some beta value over here. Let's say this is 0.5, this is 0.9, this is 0.7, this is 0.8. You'll get some values like this. Beta value, can it be negative? Answer is yes. Can it remain negative for very long period of time? Answer is no. For small brief period of time, it can be negative, positive, anything. But cannot remain negative for very long period. Can it be negative for next 5, 10, 15 years? Answer is no. Because ultimately over last many years, the market have gone up. Beta negative means when market moves up by 1 unit, your company falls by maybe, let's say if it is negative 2, so it will fall by 2 units. So market will keep moving up, company ka value will fall, its value will become 0. The company is worth nothing. It will only happen when the company goes bankrupt. So beta negative, short duration possible, long term not possible. Coming back over here. Now see, beta is representing risk. Risk can be divided into two types: business risk and financial risk. All these companies, these are competitors, peers, they all should have same kind of business risk. So what we do is we will take beta regression of each peer. Let's say beta regression 1 we have taken. I'll divide it by debt plus equity capital, market values. Okay. And debt should be after tax, the same logic that we have discussed earlier. So debt after tax plus equity, and will multiply it by equity. Just look at only this formula before multiplying it with equity. This is representing risk per unit of capital. Now, financial risk is coming because of debt part. Leverage is coming because of debt part, right? So you divide it by debt plus equity, that is representing risk per unit of capital into equity. Business risk is faced by equity. So you're removing the debt component and you are just letting it be equity component. So let's say this is 0.5 value, it will reduce to 0.35. Okay. Now you have this, you do it for all the peers. You calculate, this is called as unlevered beta. You calculate unlevered beta for all the peers, right? Then you calculate average of it. This unlevered beta is representing business risk. Then you calculate average of it. You'll get average business risk. And you will say, I am also belonging to the same industry. My business risk should be same. You'll take this average risk beta. Average beta you will take. You will divide it by your equity, and multiply it by debt post tax, your debt post tax plus equity. You will get something called as re-levered beta. Re-levered beta. This is representing business risk per unit of equity capital. You multiply it by debt plus equity, it is representing total risk. Here it is your debt, earlier it was the competitor's debt. Okay. It's not that we have divided and multiplied by the reverse amount. This is representing competitor. This is representing you. Okay. This is bottom up beta. Are we all clear with this? Okay. Next question. How would you handle company with negative free cash flows and DCF? Very, very simple. We will not do DCF of this company if perpetually it is going to generate negative cash flows. Why would I try to value a company that is going to make losses till very long period of time? I'll stay away from this. But if company is temporarily investing so that it can increase its market share, revenue, and ultimately it will become profitable, it will have that J curve. So I will forecast during the period it is negative. I'll also forecast the high growing cash flows till it becomes mature, right? So instead of, maybe generally the forecast period is 3 years, 5 years, or 10 years. 3 years, 5 years is generally done for very, very mature companies. You even don't need it 3 to 5 years. If it's a very mature company, just next year cash flows can be easily discounted. But for modeling purposes, we do it. But if it's a very, very new company that will make losses maybe for next 4 years, then for next 6 years, it will continue to grow and then it will become mature. Like Jio, Zomato, Swiggy. Last 4-5 years, they have made losses. Now they've started becoming profitable. Their growth will peak out in 5-10 years, right? So during this period, you will make the forecast. And after that, you can, once it reaches a stable growth rate as per your projections, you can calculate terminal value. So it's very easy to handle negative cash flows in DCF. Then why might DCF produce a higher valuation than other methodologies? So DCF, there are 3 components. One is cash flows, another one is cost of capital, another one is growth rate. Cash flows are cash flows, base year cash flows, how they are going to grow, the sustainable growth rate. Now, if in case cost of capital goes down or growth rate goes up, even very slightly, this is one of the limitations of DCF. They are extremely sensitive. DCF valuation is extremely sensitive to cost of capital and growth rate assumptions. So if in case you have taken higher growth rate assumption or lower cost of capital, the DCF value will automatically go up. The company is going to generate or going to grow at very fast rate, the DCF value will go up. The company is having very low risk. In that case also, the valuation will be much higher. Investors are ready to pay higher for low risk companies, right? So this is the reason. In fact, this is the reason because of which we, in the end of DCF valuation, we make a sensitivity analysis table. Here we put growth rate, here we put cost of capital, and here we put value of the company. And we get value of the company at different cost of capital and growth rate. These values will be the extreme values. Like if it is a sensitivity table, the extreme values will be representing lowest. This is going to represent lowest and this is going to represent highest value of the company. Okay. Then what are the some limitations of DCF? I think I discussed one coincidentally. It is extremely sensitive to growth rate and cost of capital. Another one, it is not a very good approach to apply when the cash flows are very volatile. Cash flows are very volatile for a company. DCF generally don't produce very good results because value depends on cash flows. Your forecast can go wrong because the cash flows are very volatile. So if cash flows are volatile, you cannot use DCF. Then the first one we have discussed is about cost of capital, growth rate. Second one is about cash flows. So all the three things are like we need cash flows, cost of capital and growth rate to calculate value of any asset. All the three things are getting impacted in DCF. Another reason why DCF or what are the limitations of DCF? You need to make a very long-term forecast. How, like I don't know, I am owner of QuintEdge, but I don't know what will QuintEdge do after 2 years, 3 years. So as an external party, as an analyst, for you to forecast what the company will do in next 10 years, you can make a try and we should, even if we are wrong, that's perfectly fine. But this long-term forecast brings some kind of uncertainty in your DCF valuation because your valuations or your forecast can go wrong. Then how sensitive is DCF to changes in assumption? Very, very sensitive. We discussed this. It is sensitive to change in cost of capital and growth rate. Very sensitive, right? I've not, I think, told one thing. I just, I think, missed it. If you calculate FCFF, the discount rate will be VAC. But if you calculate FCFE, FCFE, the discount rate is going to be cost of equity. Okay. When you calculate VAC, you will be arriving at value of the firm. From this, you subtract debt, add cash, add investment, and you arrive at value of equity. Here you will directly arrive at value of equity from operations. You add cash, you subtract, you add investments, you can arrive at full value of equity. Okay. Next, moving ahead, how would a DCF differ for a high growth tech company versus a mature company? First difference will be in the forecast. It's a high growth company, so explicit period, the forecast period will be really long. For a mature company, you don't need a forecast period. Just next 1 year cash flows are more than enough. Whatever is the next year's cash flow, calculate directly the terminal value. That terminal value, the present value of that terminal value will be representing value of that company. But even for mature company, we at least forecast 3 years so that we can capture any volatility that might come in near future. Then the high growth company, the VAC will behave like this, right? Over the time as the company matures, the VAC will come down. For this a mature company, VAC is already reached its lowest level. So it will be almost a straight line. Then cash flows of high growth company will be growing like this. For a mature company will be growing like this. Will be growing like this. It's a non-linear growth. It's a very linear kind of growth. Maybe this is generally going to be around the rate of inflation. So what happens is a mature company, a company will become mature when the quantity it can sell peaks out. For example, everyone in our country, in India, uses now hair oil. So Bajaj consumer that sells that almond hair oil, right? All of us used it. Now there is a very limited growth for them. They cannot burst out in quantities. They can move towards premiumization. There is Bajaj Almond Drops and then Almond Drops Premium with maybe infused vitamins. All these things are there. They are moving towards premiumization, but volume growth is not there. I haven't checked, but you can go and check their P&L account. You will see the growth have been around the rate of inflation. Similarly, Colgate. Everyone who should use toothbrush and toothpaste is using it. Population is also not growing at 10-12%. It's hardly growing, right? The rate of growth is really low. The absolute terms, because we have such a high base, is high. Like the absolute terms, it's a lot of people, but the growth rate is very minimal. In that case, the people who should have used Colgate are already using it. So Colgate can just keep on increasing the prices of the product. It will continue to grow near the rate of inflation, or maybe it will start introducing electric toothbrush and etc. But more or less it will be growing around the rate of inflation, right? Unless it makes a technological leap forward or some R&D breakout is there. So that's why this is how like the DCF valuation will differ for both of these companies. Then what happens if VAC changes over the forecast period? The value of company goes up. The VAC is going to come down over the forecast period. So value of company will go up. If VAC is going to increase, maybe you are investing in a company that is going to now take a lot of risk. Maybe it has gone through management change. A more aggressive management have came in, or the company is at a break or make situation where they have to invest significantly, like what Apple faced a lot of years back, right? When Steve Jobs came back, they have to make a lot of capex. So in that case, the company, if the company is going to make new investments, companies at make or break point, then VAC might increase as well till the time the company matures. So in this case, the VAC will behave like this. It will increase and then it will go down when the company matures. This is a very rare situation. Even if you don't speak about it in interview, this is fine. What happens if the VAC changes over the forecast period? If VAC decreases, the value should go down, value should go up, and ideally this should be the case. If you are making forecast for next 10 years, currently the VAC might be 25% for the company, but after 10 years it will hardly be 10%. So you should reduce VAC every year, right? Like in this case, 25 to 10, you have to reduce it by 15% over 10 years. So 25 will become reduced by 1.5% every year on an average, 23.5, and then keep on reducing it 1.5% every year. So linear reduction in VAC is there. Then how would you project revenue and expenses in DCF for a startup or a company with volatile cash flow? We will follow something called as bottom-up approach. Sir, what is bottom-up approach? To forecast revenue, what we are going to do is, we'll collect details. Let's say the company offers 3 products, right? Now we'll ask about how much quantity you are expecting to sell each year, first year, second year, third year of each product. Then at what price you are planning to sell it over multiple period, right? For each year. Quantity into price, this will be sales of product 1. Quantity into price, this will be sales of product 2. Quantity into price, this will be sales of product 3. This is bottom approach. You start building from the bottom to top, right? So this is how you do it for a startup. This is revenue, and revenue, if revenue grows, mostly the expenses will grow, right? So expenses are more, even if it is fixed in nature, if revenue goes beyond a particular point, there is no, like very rarely any expense that is absolutely fixed. If we expand, maybe it is a step up fixed, that is it will increase after some time, like rentals. If I have to expand beyond a particular point, I need another premises, I need to take it on rent, right? And expenses will be growing in line with revenue, and revenue will be projected using bottom up approach. Even expenses also, head by head, you can link it with revenue. Then, is CAPM appropriate for global investor? No, CAPM is not appropriate for global investor. There is a modified version of CAPM that is used for global investor called as GCAPM and ICAPM. Global investor is the one who have invested in many countries, not 1, 2, 3, right? Many, 7, 8, 10 countries. So for him, return of market will not be Nifty returns. There is a global market index by MSCI and maybe other data providers as well. So for him, that will be his benchmark, right? So global CAPM is basically risk-free rate of some very mature, like let's say country like USA. So some very stable, mature country where the risk is very low, that will be risk-free rate for him. Risk-free rate global plus beta. What is beta over here? I'll explain. Return of global markets minus RF. Beta is the sensitivity of global market with the company's share price. Okay. Earlier we are saying return of market and return of security. Now it is return of global market and return of security. Sensitivity of this, that is beta, that is global CAPM. International CAPM is like this investor, when he is investing globally, is not only exposed to stock markets of a particular country, he is also exposed to currency risk. So ICAPM is basically accounting for market risk plus currency risk. Similar formula here, just you add the component of currency risk. Okay. ICAPM, international CAPM, it is global CAPM plus you add currency risk. Now, how do we calculate currency risk? I don't think there will be question on this, but in case someone wants detail on it, just simply Google ICAPM and you will be able to find it. Okay. So I think these were the 20 questions that we had for DCF. These are very basic questions, nothing advanced in them. So if in case you are done watching this video, I'll ask you to subscribe to the channel and be with us. A lot of such videos are coming, a lot of such videos are in pipeline. So till next time, bye bye.